Yo, this your boy Jeff with Deep in the Bag Trading. Just wanted to go ahead and try to continue my series that I have going on, FX Essentials, going over some basic concepts that I feel like traders definitely need to know about. If I sound a little bit low, just kind of bear with me. I'm gonna try to speak up. I'm not really feeling the greatest right now, but yeah. Today's video, I want to go ahead and go over market structure. So common types of chart patterns that I feel like every trader should know. And I do have pretty good article that I ran into, and I'm going to leave this link in the description that goes over some common patterns. There's all types of different chart patterns, but there's a few that I definitely stick to. So yeah, without further ado, I'm gonna go ahead and just kick it off. So you got bullish and you got bearish chart patterns, right? Um, the first pattern that you probably want to get familiar with is your head and shoulders, and your inverse head and shoulders. So your head and shoulders is going to be a bearish pattern, and your inverse head and shoulders is going to be a bullish pattern. And these patterns, like I said, they appear everywhere. They appear everywhere in the charts, and they're basically just subtle signals that give a hint as to where the market might go next. In my opinion, they're really more so based off support and resistance more than anything, and you'll see why here in a minute. Um, but yeah, they're just subtle patterns that let a trader know where the market might go, and they're very useful. In my experience using them, they are actually very useful. Um, so the first one is the head and shoulders. And the head and shoulders is literally just that. It's characterized by a structure that looks as such. This is an example of gold's 4 hour time frame. You'll have a left shoulder, you'll have a right shoulder, and you'll literally have a head. And what this, if you really break this down, like I said, it's just support and resistance, right? So if we look here, of course we've got the peak, right? The head, and then if you're at this point in time and you look to your left, you know that that was a resistance level at some point in time, right? So this level here was a resistance level. So what you're looking for to confirm a head and shoulders, if I go back. Let's say that we're right here, right? Because you're not gonna know it's a head and shoulders until it's actually a head and shoulders, right? So let's say you're at this point in time. What I will tell you now is if I know that I had a resistance level here, and I know that because I look to my left, and I know that my peak is here. I have an inside bar here, so it looks like we came down. It looks like we had a little bit of a jolt here, and we could theoretically we might take out this high, we might approach this high, but we have to go through this resistance first. Okay. So you want to get into the habit of not just identifying the pattern after it happens. You want to get to the point where you're able to predict the pattern while it's forming, right? So if I try to find let's see if I can try to find an arrow here. Yeah, that'll work. All right. At this point in time, what I'm looking for is I'm looking for confirmation that I'm going to get a head and shoulders pattern. And the way I know that is going to happen is if price comes up to that resistance level and shows me a reaction at that level or somewhere close to that level, I can pretty much guarantee, or well, not guarantee because nothing's guaranteed, but I can pretty much assume that we might have a head and shoulders pattern forming. If we come up to this level and we reject, then I can assume that once we reject, we're probably going to have to take out first from here this level and then this level. Okay. And then once we break below that level, that would be the confirmed head and shoulders pattern, and you can continue selling on to the levels below, right? Another way that you can trade this pattern, and this is for more experienced traders, is if you're in this type of situation here and you're predicting a head and shoulders pattern to form, you can actually trade the rejection of the shoulder. And when you trade the rejection of the shoulder, your setup should be to target the bottom of the structure, with your stop loss being above the head of the shoulder or the head of the pattern. So what do these two situations look like? And before I show you that, I'm gonna actually just play this out. I'll play it a little bit quicker so you can see. But you can see here it clearly came up and rejected that resistance level. And that let me know that there's a pretty strong resistance there. And right now, I mean, as of now, I have the head and shoulders pattern. So I could have easily took this trade right after this candle, but we'll get to that in a second. And then look what happens. So we get the sell-off right out of the head and shoulders pattern. And there's two setups that you could have took here. There's two ways that you could have played this. The way that I would have played this is, me personally, I would have, let's go to, okay. So once I got the confirmed rejection, there's a couple of things that would have confirmed this entry. So we came up to this level, and first of all, I'm getting doji candles. Well, if you looked at the first video that I posted on support and resistance and candle structures, then you would know that dojis are a signal of a reversal. Okay. And then once you see these dojis, the next candle to confirm that that reversal is likely to happen is you would get an engulfing afterward. And once you get that engulfing, you can trade that engulfing, right? So a couple ways that you can do this. One way is you can trade the engulfing and enter here. And you can either have, like I said, you can have your stop loss either above the head of the structure if you want to trade the whole structure, or you can have your stop loss. I mean, somebody like me, I probably would put my stop loss above that candle because I'm just that confident. Um, and you would probably want to target the bottom of this structure here. That's a good 1.3 win ratio, or 1.3 win risk to reward ratio. So if you want to target the having your stop loss above the head, which would be a more sure way, it's going to be you're going to assure yourself that, yeah, your stop loss is deeper, but you see that this resistance level is very real. So it's highly unlikely to come all the way up and test this level and validate that structure. Okay. If you do that though, your risk to reward has to be larger, in my opinion. And it can be. It very well can be. Because in my opinion, the starting point, okay, the minimum would be right here. Okay, which, yeah, that's less than one. But in all possibilities, it could very well come down to test this support level here. Okay, which would then give you a 1.2. And then once you get there, I mean, you can go on and on. I can go on and on, but like I said, there's different ways to trade. There's different ways to trade this pattern, and you can tailor that that type of entry to whatever your risk to reward needs are. Okay. Like I said, me personally, I probably would take my stop loss being there, my first TP being here, and my second TP being here. Okay. And then everything else after that is bonus. Um, but if you really are looking to hold this for a little bit longer and you want a deeper stop loss, by all means, that's not a bad setup at all. Um, could take that as deep as you really could take that as deep as you want to. And I'll explain how you would determine where you're going to get out as well. Because having an exit strategy is just probably just as important as having an entry strategy. And again, just kind of bear with me. I'm struggling to talk a little bit, but my throat is killing me. But yeah, that's the first way that I would go about this. So the second way is if you're truly looking, if you're truly looking to trade the breakout of the Head and Shoulders, you probably could look for an entry below the structure. But bear in mind, if you do that, then again, your risk to reward has to become significantly larger than what it is. And that puts you about at a 0.87. If you would like, you can target this level here at the bottom, at the very bottom, which would give you a 1.1. So sometimes with these type of signals, I like to go by, what I would say the book, which is breaking below the structure, but it does not give me the best risk to reward. And the reason why is because if you really look close at this, your entry, if you really wanted to trade, when the candle closes below the structure, really your entry is not going to be all the way till down here. And that's terrible. So taking your entry, taking a more precise entry off of the individual candle's price action, in my opinion, would be 10 times better. Okay. You don't even have to take it that far when you do that. You could stop, if you wanted to do it that way, you could stop here, preferably stop here though, because you want a higher risk to reward ratio than one. I really would like a 1.25 minimum is what I would like. But we got it though. You did get it. And we're not even considering looking at the lower time frames, because another thing that you can do here is you can look at your lower time frames and get an even more better entry than that. This is the 4 hour time frame. So you're looking to hold this trade for a while. Okay. So that's the Head and Shoulders pattern. You can look for that pattern in the charts. It appears quite a bit. Um, Very common pattern. If you look at the 1 hour, this is pretty much the same Head and Shoulders pattern. Okay. And that's another thing that I find very interesting is that you'll see it on the same pattern that you see on the 4 hour, you might see it on the lower time frames as well. The 1 hour, it looks a lot larger because, or excuse me, yeah, it looks a lot larger because you're zooming into the 4 hour time frame when you look at the 1 hour, but it's still the same structure. Okay. The inverse Head and Shoulders is the opposite, as you might imagine. Okay. Um, I can see one right here, and I'm gonna highlight it. How do I do that? There you go. I'm just gonna put a box right there so we can kind of see where I'm looking. So if you look, I see the head. I can see what looks like a shoulder and what looks like a second shoulder. That's a Head and Shoulders. So what you're looking for is the exact opposite is what we did up here. You're looking for price to come and confirm the presence of another shoulder to confirm that you have a Head and Shoulders pattern. So if we go like this, and what I'm doing is I'm just rewinding back in time so we can kind of demonstrate what I'm looking at. I'll mark this level here as I guess what I would call my support level, right? And it looks like to me we formed a head, we get the break, we got a retest, comes back and it gets close. That's a Head and Shoulders pattern. What I'm looking for specifically, again, is I'm looking for reactions to this level here. Okay. And it doesn't have to be exactly that level. It could be close, right? So I see here that I got a reaction here and we got a jolt up. We're getting reactions every time we come into this area. Okay. Got a reaction here, we come up. Reactions here, these candles are getting beat up. Okay. This candle comes down here and we get another reaction. So there's clearly something here, okay, that is important to traders. We finally come back down, we break below that level, and we form another support. More consolidation. This is the head area. We broke above that level, we retested, came back up, retested again in the area, So it's not a perfect inverse head and shoulders. Like this one's a perfect, in my opinion. This is like a whoops. This one's like a there we go. This one's like in my opinion, that's a perfect head and shoulders because it's nice and square and nice looking. But this is still a form of an inverse head and shoulders. It's a little crooked, but you kind of get the point. So what you're looking for is a left shoulder, a right shoulder, and a head. And the more and more that you practice looking for these types of structures, the better that you'll get at predicting them and identifying them and predicting them. This is a really good version of a head and shoulders or inverse head and shoulders. So this one's a lot more square. So again, we're coming down here. We got some consolidation. So this is gonna be potentially a shoulder. At this point, of course, we don't know that it's a shoulder. We have no idea that that's a shoulder. Okay. That's actually a completely different structure, and we'll go over that in a minute. That's a bearish flag. But if we play out, that's consolidation or a flag that turns into another drop, gives us a leg down. We get the leg down, that's the head. And you have to think about this in real time because that's how you're going to trade. So we get the breakout above that level, okay? And now all of a sudden, look what happens. We can't break below that level. So we continue to consolidate. It looks like in this range right here, keep rejecting until we finally break out. Eventually, this is going to be a breakout above that area. Breakout. So a couple ways that you could have played this again, like the regular head and shoulders. You had plenty of opportunities. Okay, it's all about how many confirmations you want, right? If you're not comfortable getting in on this entry here, where we see the reaction and then we have the engulfing or almost engulfing 1 hour candle, then maybe this one is enough for you. Okay. If that's not enough for you, maybe this one's enough for you. So you had, I mean, it was like one, two, three confirmations. Okay. You had three different times that you could have gotten, and in my opinion, two solid times that you could have gotten because at this point, now you're seeing a repeat of what happened here. So you could have easily took this type of trade. You could have took a long position on the close of that candle. Okay. First targeting that level, with your stop loss being above here, which again, that's not a great risk to reward ratio. So in my opinion, what you should do, this is the 1 hour time frame. So that's a solid frame. You could put your stop loss right below that candle. If that's an engulfing, the way I would play the engulfing is you put your stop loss below the previous candle, the previous rejection candle, right? So you could put that all the way right up there and immediately target this high right here, which technically that's right there. And you're already at a 1.59 risk to reward. Beautiful trade right there. Then your second level to target would have, and again, I'm looking to my left, that's your second resistance level there. And then you know that you probably would, if you clear that level, you're likely to fill the gap up to this level. So at this point, now I'm just playing support and resistance. That's all I'm doing. So very, very simple. It's just about identifying the pattern and then utilizing support and resistance to help you set up your trades. So to set up your stop losses and take profits. 4.7 was the reward on that previous trade, by the way. Um, and again, you're welcome to play the whole structure, but on a time frame like this, on the 1 hour, those are going to be pretty deep stop losses, right? So if we look at the 5 minute and we try to see if we can find one on the 5 minute, see if I can find a tiny one on the 5 minute. That one. That's a little crooked. It's not perfect. There's one right there. And like I said, you get better and better at identifying these as you practice, right? So here's one. Here's a really good one. That's an inverse head and shoulders. Okay. So we look at that as my left shoulder, my head, and there's my right shoulder right there. Okay. That's an inverse head and shoulders. So if we look at it this way, you can take a long position as soon as you see reactions off of that support level, you can start thinking about long positions. You probably would take it on the close of that candle. And again, that risk to reward, in my opinion, is not that great. But that would be the first level. You can at least take partials there or consider taking a partial and leaving it to run to take on something a little more rewarding like this level. Okay. And then of course, once you clear that level, you're bound to hit close to this level. It's all about identifying the pattern and then identifying your support and resistances afterward to help you identify potential targets. So you would never want to trade based off patterns alone. So if we added in some more depth to this, right? What happens when we also use some extra tools as well? So when we consider the use of extra tools, like maybe your MACD, let's see here. So we got the shoulder, we got the left shoulder, we got the head, and we were already aware that this was bullish when we saw the MACD come up, and then we got more confirmation that it was bullish when we broke and retested that support and retested again and again and again. And then finally, we get the crossover again on the MACD, a full bullish crossover, and we get it to take off. So I guess what I'm trying to get at is when you combine being able to identify market structures with support and just basic support and resistance, and then you also bring in tools to help you gain more confidence, like using the MACD or an RSI or some type of momentum tool that's going to help you gauge the strength of that signal, you become pretty dangerous pretty quickly. So that's head and shoulders. Another pattern that I really like to use, and I think I had hinted at this before, is flags. I love bearish flags and bullish flags. So I think I had one that I had highlighted earlier. Try to find it. Maybe it's on the oh, I think it's actually on US 30. If we look at what's going on, guys. Oh, I'm in this rewind thing. I'm like, what the fuck? Okay. All right. Okay. Or excuse me, my EMAs. Because I'm looking for where that bearish flag was that I really liked earlier. See a bullish one right there. Let's just start out with the bullish one. I'll find the bearish one. I can't find it for some reason. I see a couple of bullish ones. So a flag, you have bullish flags and you got bearish flags. Okay. So a bullish flag, since that's where we're going to start, would be it's a continuation pattern. Okay. It's a continuation pattern off of a previous move. And it's going to be a large move that happens. So what you're looking for, okay, is just a large move, consolidation, and then another large move. That's literally all it is. So they call it a bullish flag, but it's really just consolidation after a large move. And when you think about it, it makes complete sense. What it means is that people bought up this stock or this asset, and then after that large move happened, eventually price gets exhausted and it has to cool off. And that's just the typical pattern that you see in the market. So you'll see these big moves happen, and then you'll see a cool off, right? So you'll see a big move like this happen, and then people start deciding, okay, it's time to cool off because we don't know how high this is really going to go until the buyers step in and we get a breakout. Okay, now determining where that breakout is going to happen again is not only a matter of, candle price action, like you see here, you see the engulfing on the 1 hour, which is the clear signal. And then you see the second engulfing, which is even more of a signal because you're breaking above that level of consolidation, right? So you're looking for a range to be formed, right? So when you see a big move like this happen, you see the consolidation and you see a range form. Okay, and that range is going to be a clear resistance level and a clear support level. We see reactions happening here, and then we see prices consistently failing to break this level. And we finally get the engulfing candle. Okay, and then we get a second one, and that confirms the presence of a break and retest type of structure here. So we get the break, we get a slight retest. It's not a true retest, but we do get a pullback on the 1 hour, and then we continue to push after. Okay. So that would be in my opinion, that's a bullish flag. It's not the typical bullish flag that you would see. Like they're showing right here where you're coming down a little bit, but it's a bullish flag. All the bullish flag is consolidation after a large bullish move. That's all it is. You're looking for price to hold the line. And that tells you that the buyers are still strong in that area because what could happen is we could go up and we could completely break back down, but we don't. So that tells me that we are holding the area. Since we're holding the area, now I'm just looking for that signal that, like, yo, we're holding the area, but where's the breakout? And it finally comes. We get the breakout and we get that move. So you can play this, like I said, you can play this a number of ways. You can either play this, which is, I mean, I would call this the textbook method. It'd be the break and the retest. You get the breakout, you look for some type of pullback, whether that's a complete pullback or a partial pullback. That would be more of a imperfect retest. And then you get that second candle that lets me know, okay, it's definitely okay to get in. We are showing some type of support after this candle, and you can take this move with your stop loss being below that move, or since we're on a larger time frame, and it's probably safe to put your stop loss below that candle. Honestly, that's a pretty deep stop for US 30. Um, but yeah, you can take that type of move right there. That's probably the move that I would take, to be really honest with you. So you get the break, you get the retest, and then I'm gonna put my stop below the candle that started the move. And the reason why I do that is because I know that low below that candle is protected. If we break below that candle that started that move, the chances are that this is done. This is completely done. There's no more support here. We're going to break down. Okay. But if we can hold that candle, which is we do, we're very likely to continue up, and we do. Okay. The second way that you could have played this, obviously, is and I don't recommend this type of move here. I do like to see confirmation. Is you could have played the first engulfing candle, and that's if you want to play individual price action rather than the whole structure. You see the structure, but if you want to play individual price action to get an earlier move, that's fine. You're just running the risk of not completely breaking that consolidation. And that's up to the trader. But you do get a better risk to reward. But in my opinion, if you do that, it's better to cover yourself by putting your stop loss below the entire range. Okay. So if you do that, you can target in this opinion, there's not any, or in this example, there's not any previous price action for you to target, but you would want to give yourself at least a 1-to-1 win to reward ratio in that case, which is you do get that. You end up getting 2.97, which you end up getting. But in my opinion, you'd want to at least target 1-to-1 to 1.25, and you do get that with that move. But the better move, in my opinion, would be to wait for the proper signals, wait for your break, your complete break of that zone, your pullback, and then a second candle after the pullback to show you that it's truly okay to get in. This is an ideal example here where that candle after the pullback does not blow off the top and make you miss your move, but it does give you a chance to get in it because it stops right here to let you know that there is buying support after that slight pullback. So I would take that. I would take that first situation, not this one. That'd be a more safer way to trade that. Okay, so that's a bullish flag, and I'm trying to find. I want to find the bearish one because I use bearish flags quite a bit, especially when we let me pull out my EMAs because I use them with my EMAs. Oh, oh, there it is. Found it. You know what's going. Okay. So yeah. So a bearish flag is the opposite of a bullish flag. And I guess I could have showed you I'll show you the combination with the EMA because I think it's important to have that anyway. Um, but yeah, the bearish flag is the exact opposite. You see a large move happen to the downside. Okay. And what you're looking for, and this is actually a very good example because you even get the upwards movement. Okay. What you're looking for is a consolidation. And this one is not like the previous example. It's not flat. It's more so trending to the upside. Okay, which is actually exactly what I want to see. And that represents a fake out, a potential fake out. And when you combine this with other tools, right? Like I said, support and resistance, dynamic support and resistance, your EMAs. This becomes very powerful. Um, Even when I pull out the MACD, okay, if you're trading this naked, meaning there's no tools, all right, you can still see it, okay, and I do know traders that do this. You can still see this, but you don't have very many confirmations other than the breakout of the pattern, right? So what you're looking for is that consolidation after the large move, and we do get the break. This is just a really good example. You get the breakout of the pattern, and you can literally trade this just like this. You can short this as soon as you have the complete breakout, which would be the close, and you can put your stop loss right there above the pattern. And your first target would be the bottom of the pattern, and then you can take it as far as you want to take it. Looking to your left, seeing where your supports would be, where your potential targets would be. So there's one right there. And it looks like, yeah, we did it. That's crazy. Isn't that amazing? I mean, so you look to your left. What I did was put my first target here, and I look to my left. It doesn't matter how far left I gotta go. Okay, it doesn't matter. As long as there's a level there, it's there. Look at this. So we came up and we rejected. Okay. And we knew that that was a resistance level. a small resistance level, right? So then we come all the way back to our freaking right, and look what happens. Look what happens. As soon as we hit that area, look what happens. I didn't plan that. I just did it. Okay, this is in real time. I did not plan this. So we come down and we reject and we go back up. I mean, support and resistance is very real. It's real. It's just simply price floors and price ceilings, supply and demand. That's all it is. Okay, so at this level, that's clearly a demand zone, and we go up. But if you combine this with, say, your EMAs, this is my 50, 100, and 200 day EMA, and then I throw in the MACD on top of that, now I become very dangerous because not only do I have the ability to identify a pattern, but then I also have the ability um, to confirm a move off of that pattern with very high accuracy and precision. So instead of me getting in here, me knowing what I know, I can say, okay, we got the engulfing to the downside. The trend is clearly down. Okay. The trend is already down. We get the move to the downside to confirm that this is going to potentially continue. And I could really get in on this candle. And now my risk to reward becomes that much better. This was just a very good move. Okay. And I have the MACD confirming the move. So we get the move to the downside. My MACD is fading to the downside. And this is where it becomes really nasty is I have not one, not two, but three confirmations that this is going to absolutely tank. And it dies. So yeah, using chart patterns along with support and resistance or dynamic support and resistance like your EMAs and other tools like your RSI or a MACD are very important. I wonder where the RSI was. If I pull up my RSI, where was the RSI at? I'm curious. See, so typically over 80 would be considered overbought. But at the same time, these two lines here, I don't use the RSI that often, but these two lines here would function as a sell signal right here, where you see the purple. I think where you see the purple cross under the yellow, that'd be a sell signal. Where you see the purple cross above the yellow, that'd be a sell signal. So if you're a fan of the RSI, it works the same way. I'm a huge fan of the MACD though, and it works to it works to perfection. Okay. Beautiful, beautiful, beautiful trade setup. Okay. What's the next one? So that covers pretty much my favorite patterns, the head and shoulders and the flags. Another one would be your double tops and your double bottoms. These ones are really, really good to know as well. And you can Google these yourself. Um, like right here, I looked up specifically just ascending triangles, but common bullish and bearish market patterns. And you'll see, I mean, you get plenty of examples. So you get your head and shoulders, your inverse head and shoulders. We're gonna go over your double tops, triple bottoms, double bottoms. And I mean, I'm pretty sure you know where I'm going here with those. So if we let's look at like a double top. So a double top is that's a bearish pattern. I think I had one on the daily that I looked at. It might have been Bitcoin or, well, there's one right there. That's a really good one, actually. Yeah, this is a really, really good one. So yeah, bearish or double tops, they confirm the reversal of an uptrend to a downtrend. So they're bearish patterns. And it's just that. It's literally just an area where price closes near that previous high, right? So you confirm that this is a double top when you see the price close near that previous high, and then you get the engulfing to the downside after that close, right? So we got the engulfing to the downside. So the way I love playing these patterns because these are actually they make for really good, they just make for really good setups. So you get your engulfing, and the way you can play this is you can either you can I mean really you could take some time during this candle. If you're looking at the lower time frames in here, you're like your 4 hour and 1 hour, this is the daily, you're probably already looking for a sell pattern or for a sell entry. But if you want to play the daily, then you get the close of that candle. You can put your stop here, and you can easily target this level as your first TP or this level as your second TP. And that's a better win to reward risk to reward ratio right there. Um, but now let's talk about including the extra tools again. And I'm trying to stress why it's so important to use other forms of confirmation because you just get better trades that way. So this is one trade that you'll get without using anything. Right. So if I don't use nothing, you at least have, and I'm gonna take this away for a second. You at least have those levels to target. This level here and this level here would be my second TP. Um, and then of course the rest was history. Right. If I look to my left, there's a couple of key areas that I have. So I've got that resistance level there. I see a gap right here. It looks like we might try to close that gap again or maybe fill that gap. So that's a resistance level. Here I could identify a few areas that are going to be key areas in the future. Okay, if I look here, that's a resistance level right there. And we saw that we got the rejection off that level. These are key levels that I could have targeted on the way down, right? So I could have easily took this at least to that level, at least there, okay? If not a lot further, right? Because we saw what happened to Bitcoin in 2021. All right. But if we also combine the use of other tools to help us out, we see that we actually are capable of a lot more. So for one, we saw, and this is the daily time frame, we would have saw this move coming a long time ago because the MACD was already bearish. Okay, it had actually been bearish since October 23rd. Okay, and that's nearly a month, almost 3 weeks before this signal came. Okay, so we would have saw that signal coming a while ago. So we do see the MACD turn bearish. That's not the final say in whether we're going to take the sell or not. There's other things that we have to confirm. So we see the MACD's bearish. We don't really have the price action. Okay. We do see that it does come down, but I'm still floating above my 50-day EMA on the daily. And it looks like to me, Bitcoin is trying to hold support. It's trying. So in terms of a daily signal, a long-term sell signal, we're not ready yet. We probably could take advantage of some small sells within these candles somewhere, but we're not ready to commit to a very long-term signal. And if you would have sold just off of that, you would have got stopped out at this level. When we finally get the breakdown, okay, the engulfing after we break over that high, okay, we could start thinking about sells, okay, as I'm showing here. But in my opinion, a very, very good entry would not only be to take this entry, you probably could take this first entry as a less conservative entry, like a lighter entry, but you get even more confirmation as we come down, right? So we get the recross, okay, of the MACD, which at this point I'm looking at this is we're super bearish at this point. The second confirmation is when we break below the 50-day EMA. We break in close below the 50-day EMA. We come up and we slightly retest that EMA, and then we get a second sell. Okay. So that's an even better entry now. So we can enter here and put our stop loss right above that reversal level. Because if you look, it looks like we got a small doji right there. You could probably put your stop right above that level and play that area. Okay. And of course, when you enter in there, you're looking for a much larger risk to reward, right? So my next target probably would have been somewhere down here, which nets me at least a 1-to-1 risk to reward. We continue to test that 50-day EMA. Eventually, we get the big leg down. Okay. And then my second targets would have been more areas of importance on the way down, right? So I would have had that area to look at right there. All I'm looking at is where price got hung up at before. So I'm looking at this area right here. It looks like we had an area of support right here. We've got some reactions going on right here where we were coming up. We came down and formed a little bit of support right there. That would have been an area that was respected. So we have a few targets that we could have looked at. I mean, you could have took this as far as you wanted to. This is an example of how you use multiple tools to check off multiple boxes to give you that trade setup that you're looking for. Okay. So not only do you have the double top, which is, in my opinion, that's if you want to trade just the double top alone, you would have caught this whole move. Okay. But you could have caught more moves if you had used all of your tools together. So you get the double top. You do have a bearish MACD, which is letting me know that more sells may be coming in the future. We get more confirmation when we break below our 50-day EMA, close and retest below it. And if I hide, I'm not even considering my other EMAs because I would have also used those as well. But if I just use the 450 and the MACD, we get that perfect setup where we have the 450 crossover and the bearish MACD to confirm. That was just a beautiful signal. Beautiful trade signal there. Okay. So that's an example of a double top. And then that's an example of how you would use that in addition to other tools to give you a good trade setup. Um, Another example is another structure that you would really want to look at is a double bottom, right? So a double bottom is the exact opposite of a double top, and you see a lot of those in the market also. Let me see if I can. I'm trying to find a perfect example. See that's a small one, but see if I can find it in US 30. I see him on US 30. US 30's just been on this one. Let me look at the 4 hour or the 1 hour for US 30. Wait. Kind of one. Not really exactly what I'm looking for. That's an imperfect one. What happened here? Nah, not necessarily. Let's try it. Oh, wait, there goes one. That's a small one right there. Okay. I'll work. I can do that. That's fine. This is the 1 hour. So all right. So yeah, double bottom. Yeah, like I said, double bottom is the exact opposite thing. So what we're looking for is instead of a resistance level that is respected and reacted to, we're looking for a support level, potential support level. And how do we know that this is a support level? Well, price is going to tell us. When price comes down, we saw a reaction, okay, at a certain area. Okay. So I'm already looking now when price comes up, I'm either looking for if I'm here, where's my rewind button? So if I'm at that point in time and I see this happen, I'm only looking for two things to happen, or well, technically three. I'm only looking for three things to happen. I'm either looking for price to come up and potentially retest my 50-day EMA or crossover and confirm that we're either going to get a sell or a buy up to this area here. I'm looking for the consolidation to happen and If that consolidation happens for long enough, then it's going to start to look like a flag. Okay. If it looks like a flag and we continue out, let's look at where the freak is my arrows at. If it looks something like this, okay. If it continues to look something like that, and then this EMA here comes down like this, that's going to be a flag. That's one of the situations that can happen. If we see something like this, okay, where price kind of banks off of that candle, we saw the engulfing, or we saw the green candle close, that lets us know that the buyers are trying to get into the fight here. We might end up with a breakout and a retest of the 50-day EMA. Sorry, a slight retest and then a move upward. That might happen. That's two situations that might happen. Okay. And the third one is basically a cancellation of the flag, right? So we might see the flag happen, okay, and we see that we see a rejection here, and then what we're looking for after the rejection of that support level, of that previous level, is for us to break out of that consolidation and continue up. So that's the third thing that might happen. Okay, but in order for that to happen, we probably need a few other confirmations, and you'll see what I'm talking about here. So let me get all this crap off my screen. Okay. So if I play this out, that's a double bottom setup. So we saw the flag start to try to happen. Okay. And if you're playing this without the use of other tools to help you confirm, it's going to be a little difficult to see this happening because after this large move, to me, without anything else, it does look like this is going to sell. I'm just being fair with you. I mean, this happens. It does look like it is going to sell. But when we see that this level is consistently being reacted to, okay, we had a level here where I mean, obviously the buyers were interested right here. We had rejection here and engulfing here. You probably could have took, I mean, really, honestly, you probably could have took that entry there. That would have been fine to take that. Came back down. We retested the level again. We got another engulfing. We just keep getting these engulfing candles at this level. Okay, so now at this point, if you take this entry, in my opinion, you take this entry, you put your stop right below that level or a little bit lower just to give you some buffer, you're safe. You take this entry because you see that this is the engulfing above that level, you're safe. But since you are in a downtrend, you're technically at this point in time in a downtrend. It's probably in my opinion best to wait until you're above that level. When you're above that level, okay, you can definitely guarantee that you're going to see more to the upside. Okay. The only thing is that if you take that entry there at that level, that doesn't mean you're going to put your stop loss all the way below the double bottom. Okay. It just means that you had in the past, you had a double bottom to help you confirm that there was some type of support there at that time. Okay. So if you get in here, you've got this support level and this support level. It's like I'm above two different support levels. Okay. And that's how I would trade that if I was trading it naked. I probably would wait until we were above that level and probably put my stop below there. But that still doesn't give me the best type of trade scenario. And that's why I use other tools. Okay. So if we bring in my EMA and my MACD again, my best friends, Okay. When we come down, I'm clearly seeing that this is a sell. This is a sell situation. All right. So we come below the 50. Classic. We retest the EMA. We get the sell to the downside again because the MACD is giving us the MACD is giving us a sell to confirm it's going to happen. We we see the engulfing to the downside on the 1 hour. That confirms that move there. But look what happens to the MACD here. So we get a crossover kind of like we did here. And up until we get that breakout, it's looking a lot like this. Okay, it looks a lot like another flag about to happen. Okay. But instead of getting that flag, we get the breakout above the EMA. It closes successfully. Looks like it comes down and try to retest that level one more time. Okay, so we're not quite ready yet. You might have got faked out here. You might have took that entry. You might have gotten faked out, and that's okay. You're gonna lose every now and then. So you could have took that if you're playing the EMAs and the MACD, you could have took that move. Or if you're waiting for this level here to be broken, which is very smart. Okay, if you're waiting for that level to be broken, you get a break above this level, okay, and then you get the retest again, and then we continue to buy on. Why is it smart to take that level? Because one thing that we haven't talked about yet, or I think I've mentioned it only a few times, is that you want to pay attention to when the market is making lower lows and lower highs, or whether it's making higher highs and higher lows, right? So at this point in time, I see that we had our starting point of the downtrend. We had a low, okay, and then we had a higher low, or excuse me, yeah, a lower high. Sorry, we had a lower high at this point, right? So when you see a lower high, what you're gonna look for is for that previous lower low or low to be broken, right? So when that happens, that means for me to confirm that this is a uptrend now, I have to break above the level that started the last leg down. Does that make sense? I have to break above the level that started the last leg down and led to the most recent low. Okay. So, and again, this is the pattern. All right. So we started a high, we make a low. We come up above and we make a lower high, right? Once we make that lower high, we get a lower low. We come back up again. Why are we not officially in an uptrend? Because we had momentum, right? Coming off of the double bottom here. So this would have been an okay short-term trade, but in the grand scheme of things, since we're in a downtrend, we want to look for complete confirmation before we start buying. Okay, this is how you trade a reversal. You're looking for the most recent higher or lower high that created the most recent low to be broken. And since that does not happen, it's not that safe to hold a long-term trade in the upwards direction. You could have gotten in off. I mean, it's up to you. If you want to, take the risk off of that double bottom and that MACD up to the upside, be my guest. You can try to target that level, and it does come close and get you a good return, but not as much as a return as if you would have waited for another sell. Okay. If you waited for another sell, you could have took it. It would have been safer. It would have been safer, in my opinion, it would have been safer to take the sell right here with your stop loss being here and for you to target this low. Okay. Even though it does not hit it, it would have been the right thing to do. If you're considering the fact that this is making lower lows and lower highs, it would have been the right thing to do because you're in a downtrend. You want to take sell trades. You don't want to trade against the trend. Okay. But since we're talking about trying to play off of this double bottom and catch a reversal, I'll tell you how you do it. So if you want to do that, then you're going to want to look for, again, the most recent higher low to be broken. And since that does not happen, it's not safe to take the trade for for a long position until that actually happens. So we get the downtrend again. We come back above the EMA again. We're getting nothing but positive signs. Nothing but positive signs. We break above the EMA again. At this point, I'm stalking US 30. We get above the 50-day EMA. We have a MACD cross up to the upside. We're looking great. We come back and we retest. And at this point, you can take it. You can think about taking a long position. I mean, my MACD looks like it is fading off. I think this was towards the end of the day too. So it probably would be best to, if this had happened during the early part of New York, would have been nice. But you still could have took that trade. So we break above that level. And then we continue. It looks like we came back and we eventually retested the 50-day EMA. And we continue on to the upside. It was a slow grind to the upside. Okay. So you could have probably played that, breaking above and taking that entry there. I would have took the break and retest. So you would have broke, retested, had an entry here, put your entry right below that area, that previous flag, that area of consolidation, and you would have been safe. So maybe like right there. Where would my target be? My first target, yeah, this is easy. My first target would be here. My second target would be there. And why is that? Because I'm looking to my left and I'm looking for areas where the price previously showed me a level of resistance. So I always target previous levels of resistance for my take profits. And I try to target key levels of support or resistance, whether I'm buying or selling, for my stop losses. If I see that previously we made a low and we had some consolidation, I mean, really, I would want my stop loss here, but that's a little deep. Okay, we get in at 4608. Yeah, I'm not taking a 400-point stop loss. I might take a 200-point stop loss if that means that I'm going to make from 622 all the way to 4139, if I'm going to make 700 points. Okay, but then you got to adjust your position size accordingly also. The point is that it's a 2.46 window reward ratio in that case. Even at TP2 and at TP1, it's a 1.46. So it's all about playing your risk to reward as well. That's really, in my opinion, the most important thing behind these setups. But if you would have took that entry, that would have been one way to do it. Or if you want to use, like I said, you want to bring in your tools, right? If you want to use your whole arsenal of tools to give you the best trade possible, really, in my opinion, the best way to trade this would not only be to take the break and retest. That would have been one entry. You probably could have took a lighter entry there. Okay. And the reason why is because the best entries to take would have been the entries along the 50. So you take this break and retest here, and then we not only broke and retested this level again, right? Because we have a horizontal support level, but then we have the dynamic support level as well. So we have two levels of support, plus my MACD is fading to the upside. This would have been an even better entry. Way better entry right there. It never comes back. It almost never comes back. When it does, it immediately comes back up. We immediately get a reaction to the upside. Comes back down here again, and we got to grind up to the upside. So That's the way that I would have traded that. There's a few ways that you could have did this, but I'm trying to go from just using the double bottom to using the break and retest of the horizontal level to bringing in the full suite of tools that I would use, which would be using the horizontal level of support, my MACD and my EMAs, in addition to the fact that I do have some support here to show that this is where the trend started. And now that I look at this, it's also making higher highs and higher lows. It's making a high here, a low here, a higher high here. It looks like it did try to give us a break to the downside, but that swiftly got rejected because we had levels of support to rely on here and here, whether that be dynamic or horizontal. So not a bad trade setup there. Okay. I think that is, I don't know how much time I'm at, but I think this has been going on for quite a bit. But those are some examples of key patterns that I like to use. Like I said, head and shoulders, inverse head and shoulders, double tops, double bottoms, bearish flags, bullish flags, which are just, they can serve as continuation entries off of previous larger moves to give you more moves in the future. Again, a bearish flag would be consolidation after a large move. A bullish flag would be consolidation after a large move to the upside, right? Just like you see right here. That's kind of a bullish flag, right? So you see a large move and then you see a grind down, right? But what tells me that this is going to come back up? Well, for one, I'm still above my 50-day EMA, and for two, my MACD starts to fade up to the upside, and I get an engulfing candle, right? After that consolidation. So I think the biggest takeaway, besides the structures themselves, are that you never trade against the trend. You always want to make sure that you are trading with the trend. And that goes with making sure you identify whether your market is making higher highs and higher lows like you see here, or whether it's making lower highs, sorry, lower highs and lower lows like you see here until you get some type of confirmation that that reversal is happening. Okay. So like I said, one thing that I didn't cover as much, but it doesn't take a whole lot to cover is higher highs and higher lows and lower highs and lower lows. It's so important to do that. And I can't stress that enough. Here you are making higher highs and lower lows. And yes, I see that we have moves occurring to the downside. But would you rather take this move or would you rather take this move? I would rather take this move, okay? And just because I see some types of moves occurring to the downside doesn't mean that I'm going to take sells. So if you look at it just from that way, you're never going to take a sell during an uptrend. Another way you'll look at it is that, well, yeah, you see some moves occurring, you know, to the downside, like right here, but that's really just consolidation, and it's almost like like a bullish flag. Okay, which is, like I said, it's just consolidation after a larger move. So you get this larger move, you get a bullish flag, and then you get a move to the upside, the breakout of the flag, which is what happens here. So I would challenge you to go ahead, and there's plenty of resources online that you can easily look up. Like I said, I literally just Googled common bullish bearish market patterns. And this is what I got. I mean, you get these common patterns. They've even got falling wedge and rising wedge, which is, in my opinion, that's literally just a bearish flag and a bullish flag. That's what that is. They call them different things. Um, but yeah, you can find this for yourself, and you should hopefully this will help you in your trading. So I hope this has been helpful. If you like the content that I'm posting so far, feel free to hit the like and subscribe. And like I said, I apologize for I might sound a little bit funny, but my throat is killing me. and I am not a YouTuber. I'm just a trader. So y'all take it easy. I'm gonna cut this out and I'm going to bed. Take it easy.